Hi, I'm Ken Shinoda. Today is Tuesday, March 3rd, and we're going to review the DoubleLine Total Return Bond Fund. Here you can see the different available share classes of the DoubleLine Total Return Fund, minimum investments, minimum IRA investments, and gross expense ratio of the different share classes. All right, well, let's look at 2025. It ended up being a pretty good year for fixed income. A little bit of a rocky start to the year, but as inflation continued to make progress, the Fed started to cut rates again after being on pause, and the economy not going into recession. We saw tighter credit spreads, lower rates, and strong returns for fixed income. You can see 2025 ag up 7.3%, high quality fixed income, treasuries up 6.3%, agency mortgages playing catch up with corporates, seeing some spread tightening, actually outperforming IG, the agency CMBS index up 860 versus investment grade corporates up 780. Good year for high yield, also up 860. Levered loans being floating rate, lagging a little bit. Levered loan index up 590. And the riskier parts of the levered loan market underperforming, up only 3%. EM, huge run, especially local currency with weakness in the dollar, up almost 20%. Equity-like returns. And securitized credit, shorter duration, also spreads wide to corporates, having solid returns anywhere from the 6% range to high single digits for some of the riskier parts of the capital structure that benefit from wider spreads and also spread tightening. As we turn the calendar year to date, still positive returns for fixed income, but a little bit of a divergence. With rates coming down, high quality parts of fixed income continue to do well. Agency mortgage spreads with the announcement from the Trump administration of support for the agency market by the GSEs, Fannie, Freddie, Ginnie Mae, to potentially buy up to $200 billion of agency mortgages. Spreads tightening all the way down to almost 89 basis points on current coupon MBS, widening since back towards 100. But you can see through February 28th, end of the month, agency CMBS index up 2.1%, outperforming corporate bond index 150, and Treasuries up 170. So high quality fixed income doing well. Securitized credit markets also doing well. Spreads have been tightening there, again playing catch up to corporates. But there's divergence. Where is there divergence? Where if you look at the equity markets, it's been this scare that AI is going to take over some of the businesses and jobs that are out there. Specifically, software has been hit the hardest. Levered loans have a lot of software exposure. Over 15% of the levered loan market is the software names or software exposure. Also, private credit has a lot of software exposure, and that's where you see a lot of headlines these days about losses and potential defaults and money trying to get pulled from some of these funds out there. So that's where the pain has been. Will it spread to other parts of the credit markets? Only time will tell. We went from fears of AI to now the crisis in the Middle East with the attacks on Iran, spike in energy prices. So definitely some volatility back in the marketplaces. We think it's going to make for some opportunities. We're pretty defensively positioned in many of our portfolios, including the DoubleLine Total Return Bond Fund. And so we get excited when we see vol. And I think we're positioned well to try to take advantage of that volatility if credit spreads do widen. All right, looking at performance now. At the bottom of this page, we can see through the end of last year, December 31st, 2025, solid year of outperformance, 74 basis points, excess return relative to the ag. 3 years now, 80 basis points ahead, 5 years, 92. Thank you for your patience through those couple of years with agency mortgages lagging, but from the cheap levels they got to in 2022, 23, as we talked about many times on our webcast, that they would lead to some great returns coming back and mean reversion in agencies, and that's exactly what's happened. Almost 100 basis points of excess return on a 5-year annualized basis, annualized net of fees. Year to date, off to a decent start, 31 ahead of the index with those agency mortgages doing well. Securitized credit also having some spread tightening, enjoyed high carry. As we look at the returns by the different parts of the portfolio, here just wanted to highlight not only year to date, credit up 161, agencies and treasuries up 260, but now you can see 3-year returns for credit portfolio, almost 8%, 773 1 year, 770 3 years, And that now compares with corporate bonds doing around 6.5%. And so we always talk about securitized credit having that yield advantage over corporates over longer periods of time in fixed income. If you have a higher yield and your bonds mature, you will outperform by that yield advantage. So we're experiencing that 100 plus basis points of yield advantage over corporates, creating that, helping create excess return. 5-year basis with rates rising, shorter duration being one of the hallmarks of the securitized market. Securitized credit 381 over 5 years versus corporate bonds up only 81 basis points. Agency mortgages, 5-year numbers up 1% or so, a little under 1%. Treasuries up negative 10 basis points. So with the last couple of years, agencies have really caught back up relative to treasuries as well. You can see agency MBS 3-year return for our book up 637 versus the MBS index up 542. So almost 100 basis points of excess return for our agency book actively managed relative to the agency MBS index. So how are we positioned today? Well, you can see that about 56% of our portfolio on the right-hand side is in government guaranteed type securities and or treasuries. When I say government guaranteed, I mean Fannie, Freddie, Ginnie Mae. These are the GSEs that wrap those securities and make them government or quasi-government guaranteed. And then 43% of our portfolio in securitized credit, mostly non-agency mortgages at almost 25%, about 8% CMBS, 6% asset-backed securities, and 4.6% in CLOs. The CLOs largely AAAs there. So I think we're really well positioned. We have, we're on the lower end of the range for credit in our portfolio. We've got a lot of government-backed securities, which if we do see a risk-off in equity markets, we think that those will outperform. And then maybe that pushes spreads wider and gives us a chance to add back to the credit and take that back up higher. Average dollar price, still at a discount, $95 price. Duration, a little bit shorter than the index, 5.4 years versus 580 on the index. And single A plus rating versus AA minus for the index because we own some more credit, but our credit is much higher quality, don't have any high yield, don't have any corporate bonds in here. What kind of changes have we been making in the total return bond fund? Well, here's the year over year look at the portfolio. We definitely saw some spread tightening in agencies. We've been taking some chips off the table there. We've moved a little bit to credit, but we've actually added to treasuries. And treasuries are kind of a place to park cash and wait for maybe some spread widening. And we sold when agency mortgages got down to that 89 basis points for current coupon. We're back out to about 105 spread. So pretty decent move and not adding back yet. Maybe we'll see a little bit more vol, shake up the markets. So we've gotten a little bit more defensive even in the agency book, taking down agencies. You can see pass-throughs down 3%, CMOs down 2%. Within our pass-through book, we've been making an active rotation out of down in coupon and moving up in coupon where we get to pick up some spread. And so we have somewhat of a barbell right now. We'll look at that in a second between lower coupon pass-throughs and higher coupon pass-throughs. In the CMO book, these are collateralized mortgage obligations. We saw some tighter spreads on long CMOs with insurance demand, making spreads go tighter there. We've been shedding some there. You can see we're down about almost 4% year over year. Adding to floaters, adding to interest-only securities. So these are, you can take a mortgage bond, you can strip its principal and interest, and you can just have exposure to that interest component. And those are, we think, pretty cheap. They trade kind of like 150 to 180 nominal spread. That's kind of the same as like BBB rated credit. And it's off of really out-of-the-money mortgage bonds. So there's no prepayment risk. When you buy IOs, you're worried about prepayments. Here, these mortgage bonds have coupons with 2.5% to 3.5%, and mortgage rates are up near 6%. So no worries about prepayment risk at all there. And we've been adding there to interest-only securities. Credit, while it doesn't look like there's been much changes in the actual allocation because it's been about the same, there's changes happening underneath inside those portfolios. Rotations have been happening, moving up in the capital structure, moving to different pockets of the CMBS, ABS, and RMBS markets. And we're going to look at that on the next page in a second. Credit rating, about the same, single A plus, but The investment grade portion has gone up. Essentially, what's happening is there's some non-rated bonds that we bought back in 2015-16, even some non-performing loan bonds that are non-rated that we've been buying over the last couple of years. They've been paying off. They've been paying down, and we're rotating them back into new issue bonds with ratings. Not that the non-rated securities we had were below investment grade. We believe they still had the risk of, let's call it, triple Bs. But as those have been paying off, seeing more opportunities in rated securities, and so rated securities going up, non-rated and below investment grade going down. Below investment grade, those are probably those legacy non-agencies. They just keep paying down, they keep refinancing, and as those pay down, they're not making new old bonds, so that'll come down as a percentage of the portfolio. So credit quality continues to go up. If I go back a couple years, average credit rating used to be single A minus, so there's actually been an upgrade in credit quality over the last couple of years. Thematically, this is something we've been doing across all our portfolios at DoubleLine. Okay, look at the agency detail. I'll highlight the bottom left. This is a distribution of the coupon stack. You can see we kind of have a barbell. We've owned some of the down in coupon, this 2s, 2.5s, 3s. Then we don't really own much of the intermediate part of the coupon stack, not much 4s and 4.5s. And then you start seeing that we have exposure in 5s, 5.5s, and 6s. So this is that barbell I was talking about. Down in coupon to pick up spread duration, deep discounts. If spreads tighten, these bonds will benefit the most. Up in coupon, if spreads don't tighten, up in coupon has more spread, you clip more carry. And so you put them together, you kind of end up with a nice spread, but a better convexity profile and a portfolio that can do well in both falling and rising interest rate environments. Top right, some of those CMOs we talked about that we've been liking, IOs now almost 4% of the portfolios, floaters almost 3% of the portfolios. Those Z tranches, these are long duration CMOs, have been coming down, now only 2% of the portfolio, and some active rotation as we see opportunities there. But again, it's been a good run for agencies, a tough time coming out of COVID with quantitative tightening. We saw a lot of underperformance for mortgages into 2022 and 23, but coming off those wide spread levels, now we're enjoying those wide spreads that have been tightening in. A lot of the headwinds for mortgages now turning into tailwinds, and now you've got government support with the Trump administration wanting lower mortgage rates. And I think that is something that the portfolio can benefit from, is that there's a semi-quasi backstop now, it seems, for agency mortgages. Okay, credit portfolio, top left, almost 25% of the portfolio is in non-government guaranteed mortgage-backed securities. We still have a core exposure of 10% to legacy RMBS. These are those bonds from the pre-crisis era, pre-global financial crisis. We've had a couple other small crises over the last couple of years, like COVID. So now I got to specifically say global financial crisis. But these bonds have benefited from, 15 years of almost 20 years of seasoning now, right? And a lot of these bonds were made in 2005, 2006, and the borrowers have seen a lot of home price appreciation. They made it through the GFC, they made it through COVID. They've been paying down their mortgages. Home prices are up a lot, and that part of the portfolio actually did 10-11% last year. So it did really well, and we still like that core holding. What you're going to see happen is that non-QM, non-qualified mortgages, these are new bonds being made by new mortgages. That's the biggest part of the non-agency market today from an issuance standpoint. That will go up as a percentage of the portfolio. Legacy and NPL, RPL, those are legacy loans that were packaged into bonds. Those will go down because they're not making any more of those, and new origination will become a larger part of the portfolio. Second largest credit asset class, commercial mortgage-backed securities. Got to give credit to the team. It's been a rough ride for commercial real estate between the GFC, and then you had COVID, then you had rates rise 500 basis points, everything going on with office space, and now you've got AI displacing companies and things like that, and they've done a great job navigating all the turmoil. And we think it's one of the safest places to be because new issue CMBS is pricing in so many bad things. So we're pretty diversified. We've got about 4% in conduit. These are diversified fixed rate loans packaged together into bonds. large loans or single asset, single borrower, otherwise known as SASB, about 2.7% of the portfolio. These are loans backed by either one asset or a portfolio of assets, usually one borrower, large borrower, private equity, REITs, borrowers of that nature. And then commercial real estate CLOs. Unlike bank loan CLOs, these are financing tools for originators that hold the subordinate equity tranches. These are floating rate commercial loans. Largely, we're playing up in the AAAs. And as you look at the mix of the portfolio, pretty diversified across the different pockets of the commercial real estate market, heavier weighting towards multifamily. Only 1.86% of the aggregate portfolio is in office. And of those loans that are in office, we've gone through all of them. We're comfortable with them. And don't be afraid of office, because you can make good bonds backed by good properties with low LTVs. It's all about the right property. There's properties out there that are fully occupied with low vacancy rates because they're high quality office buildings that are in demand with all the amenities. And then you have places like downtown LA, where I'm sitting in today, with a building behind me that's probably 50% vacant right now and in trouble. So you have to do your homework. You can't just buy an index fund when it comes to CMBS, but we feel like we're taking advantage of opportunities there. CLOs, 4.6% of the portfolios. Here you can see almost all that in AAAs. AAAs have so much subordination. You can sleep at night, 30+% subordination. If defaults pick up in the bank loan space, they actually pay down faster. And so we think of the AAA CLO as kind of like a cash plus place to be. And lastly, ABS, 6% of the portfolio, very diversified. A lot of concerns out there around AI and data centers. Here you can see data infrastructure is only 1.17% of the portfolio. And what we consider data infrastructure is not just data centers, it's also things like fiber optic network. That's probably half of that. And of the data center exposure that we do have, it's all the what we call old school stuff, cloud computing, things like that, multi-use type storage facilities. And so it's not these hyperscalers that are issuing bonds. That's stuff that's coming into the IG market and the IG corporate market, that's coming into the private credit space, that's coming into the high yield market right now. So very little of that AI exposure. Mortgage-backed securities obviously have really no risk there. So we like to think about total return bond fund as a place to hide from all those troubles right now, with very limited exposure to that type of AI risk and software risk. Looking at yields and spreads on the portfolio, what I really just wanted to highlight is the discount dollar prices that we can still find. Some of the interest-only securities that we own in CMOs and CMBS kind of skew the weighted average dollar price. So I'll just point you to the agency MBS pass-throughs, $95 price. At a $95 price, you have a lot of convexity. These mortgage-type bonds, average dollar price of $95. You can probably see that easily go up to 101, 102. So for at least 100 basis points of rates falling, we have solid convexity in the portfolio. Weighted average spread on the treasuries and agencies is 80. If I took the treasuries out, it's probably closer to 90-ish on the agency book, which is contextual given current coupons about 105 today. And on the credit book, almost 200 spread, with corporate bonds today with a 80 handle spread. So picking up over 100 basis points in our credit book, in aggregate, giving us a yield advantage over the index of still almost 70 basis points, running that shorter duration, which is helping today with rates backing up, and wanting to be a little bit underweight the long end. We'll look at key rates in a second. So here you can see duration is on the higher end relative to history, but still a little bit short. Historically, we've always been a little bit short. Today, we're about a half a year short, and really underweight that long end. Yeah, the long end's done okay recently, but fiscal spending continues to be a theme globally, also in the U.S. The deficit is high, could continue to grow higher, and every now and again we get these bursts of negativity around that globally. We saw one earlier this year with JGB yields rising, especially on the long end JGBs. The whole globe kind of sold off with that. We've rallied since, but We like being underweight that long end of the curve. You can see a little bit more exposure on the 2-year, because if things go sour economically, it's more likely that the Fed cuts than the long end rallies. We have basically more certainty in our view that if things slow down economically, let's just say job losses start to pick up or job creation starts to drop, we think it's more likely than the Fed cuts than the long end necessarily rallies. So we like to have this 2s, 30s steepener position on. All right, well, what looks cheap out there? Even though it's rallied, the securitized sectors are still screening cheap. This is a percent out of rank. The lower the dot, the more expensive the market. IG Corps and high yield were both down at 0 earlier this year. They've widened a little bit, so I wouldn't say they're cheap yet, but they're at least not at their all-time tights. Agency mortgage is still cheaper than average. RMBS, kind of average spread. And so, we still own credit. If you're going to buy credit, we still think those securitized markets offer better relative value to corporates, but we're on the lower end of our allocation to credit, waiting for some volatility to create some buying opportunities out there for us. Here you can see current coupon was down, almost got a little bit below 90. Now we're backed up to actually 115. I guess we sold off a little bit more yesterday, back to 115 on current coupon. Treasury yields, they've sold off the last couple of days, but that's after a rally. So we're basically back to where we were. This chart isn't granular enough to show you, but the 10-year got down to about 390. 405 was yesterday's close. We got up to 410 earlier this morning. Today is March 3rd, Tuesday. 230s just kind of hanging out at around 120 today. We had a big move up in the curve, and but now we've been going sideways. Both 210s and 230s have kind of been going sideways. And this is looking at the FOMC dots market, basically getting a little bit more hawkish with what's going on with oil prices, what's going up with energy prices. Not terribly hawkish, but basically saying, hey, maybe those cuts aren't coming until summer. And that's after Powell would come out. And we'll watch this. I think this could move more. There's been such a violent move in oil prices. Oil was as low as $60 a barrel. Now it's 80, that we could see some movement in the market's expectations for cuts next year. And you can see that playing out in break-even inflation rates, 2-year break-evens spiking. Long-term inflation expectations still relatively contained, but those short-term expectations with what's going on in the Middle East spiking. Won't go too much into macro because we're going to have a webcast from Jeffrey talking about macro, but wanted to just highlight a few things we've got our eyes on. What the market is really looking at is payrolls. Payrolls got weak, so the Fed started cutting again. Payrolls have been improving. So if payrolls do not get weak again, this makes it harder for the Fed to cut, because inflation could stay sticky, and if jobs don't deteriorate, then maybe they feel like they don't need to cut anymore. Now let's look at some of the metrics of the underlying assets we own as we look at ABS, consumer ABS, and mortgage-backed securities that are non-government guaranteed. We can see that mortgage delinquencies remain pretty contained. While there has been an increase in consumer credit cards and auto loans, it's really just coming back to levels that we saw pre-COVID. On auto loans, a little bit higher. So we've been decreasing some exposure there. We've been staying up the capital structure. With the type of exposures we have in investment grade, I'm not really worried about this, but it's always good to watch these type of metrics as far as delinquencies are concerned. Student loans, that spike has to do with the end of the freeze on student loan payments. Most of those are going to be those government Sallie Mae loans. We don't own any of those in our portfolios. Home prices, it's kind of a mixed bag. Nationwide, low supply continues to support home prices. Through COVID, home prices didn't go down. They actually went up because of lack of supply and increased demand. Then we had rates rise 500 basis points. People thought home prices were going to collapse. They went down nationwide less than 5%. Then they rebounded. All has to do with supply. There's just not enough supply relative to demand. Household formation has been exceeding new home creation over the last couple decades post-crisis. But certain areas have been building more. States that have land, so think Florida, Texas, Colorado, Arizona. And there have also been places that have seen demographic growth because of low taxes, sometimes politics. And so places that went up a lot in price because of those demographic moves and have been building, those are the ones that are lagging. Tampa, Denver, Phoenix, Dallas, Miami, lagging the market. And then the Northeast and the Midwest kind of lagged the South and Southwest and Southeast in price appreciation, especially the Midwest. Now those are the strongest parts of the market. Chicago, New York, Cleveland, Detroit, Minneapolis, up in price. Chicago up 5%. And so now you can see on a 3-year basis, everywhere's still up. Tampa up the least, but the Midwest kind of up, teens, 20% for Chicago. So I think you're going to continue to see this regional story. Midwest, Northeast, just have less supply of new homes on the market, less supply of old homes on the market. There are actually more homes for sale in the entire state of Florida than the entirety of the Northeast put together right now. But we think home prices probably go sideways. Much of what we own is stuff we bought a long time ago. Those borrowers have been paying their mortgages. LTVs have been coming down because they've been amortizing their mortgages, and home prices have gone up for a lot of the legacy assets that we own. Most of what we own is from many, many years ago, not just bought today at today's prices on homes. Commercial real estate have largely bottomed. Even office, you're starting to see some office prices go up. This is the same sale index, so you need properties to be sold again. So it doesn't necessarily reflect, exactly what's going on in some of these sectors because you need properties to trade. But broadly speaking, the market's healing. You're starting to see properties trade. There's still going to be idiosyncratic defaults and losses on office space and things like that. But what's fascinating is how much retail kind of outperformed. You would have thought retail would have outperformed, apartments would have outperformed retail, or because retail was a problem child many years ago, it was already priced to higher discount rate or higher cap rate. And what hurt apartments was they were priced to perfection and the risk-free rate rose. And so they didn't have enough spread or cap spread to cushion it. But we like commercial mortgage-backed securities. We think that the new bonds being made today have really good underwriting on the loans, and the market basically self-corrects. And usually after tough times is when it's the safest time to buy certain sectors because they're pricing in worst-case scenarios. This is CLO levered loan defaults. You can see levered loan defaults have been picking up. The subordination levels on AAAs, which is what we own, is 25, 30%. Even during the GFC, default rates never exceeded 10, 11%. So at the AAA level, you're so secure, wouldn't be worried, sleep at night asset. But I just wanted to point out to where we are in the cycle there. So hope you enjoyed our first total return update here. We're going to be doing these now on a quarterly basis, separate from the macro webcast that Jeffrey Gunlock will be hosting. Thank you for your support at DoubleLine, and we look forward to catching up next quarter.